This massive rally in Bitcoin is likely going to continue. The 28K is likely just the start if we can believe a backtest, a simulation of buying and selling Bitcoin in the past that would have resulted in this nice performance graph. So in turquoise, we see the backtested result. In white, we see the Bitcoin price. Now, what's that simulation? What's the strategy? It's optimizing for a moving average. So you want to be buying in whenever the price is above the moving average, and you want to be either selling or betting on falling prices whenever the price is below the moving average. And you want to find out what's the best duration for the moving average for each different asset. And so when we look at this for Bitcoin, we are above the best simple moving average here in turquoise. So we are long betting on rising prices since the 11th of January. Currently, the support is at roughly 26K. So if we close a day below that price level, we would turn bearish. But right now, with the recent rally, we stay bullish. Whenever the price is below the moving average, we would be betting on falling prices. We would not be bullish. We would not have positive exposure to Bitcoin. Now, we have discussed this in the premium membership, in the Telegram chats. There are regular videos. Every 2 or 3 days, we talk about Bitcoin and various altcoins. And for the US dollar valuation, what's most important is always where the leaders are headed. Where is Bitcoin headed? Where is Ethereum headed? Because those two assets in the end influence a lot for the whole entire crypto space. Now, let's talk about the simulation of buying and selling and how we can take advantage of this. So this is the result. The simulation starts in 2018, but I've also done this even further back with very similar results. This is a linear scale, so we can't really see what happens here in the early days. This is the same graph here on a logarithmic scale. So now every horizontal line here is a 10x from one another. And here we can see how the outperformance is pretty consistent, as in the delta between the Bitcoin price and the portfolio line increases with time. And the main reason why this outperforms so nicely is because we avoid those crashes, or we even make money from those crashes. So during bullish times, we pretty much earn the exact same, right? There is no leverage in this backtest. But during bearish times, we avoid the negative exposure. We simply just continue to creep upwards with time. So you want to find out what's the best duration for a moving average. Because let's say you've got the 100 day, you might think, okay, this also tends to make sense. You've got a bounce over here. Why not take the 100 day? You could also take, say, the 50 day. Then the line is closer to the price. You could say, okay, we enter here a little bit earlier. And especially during bearish times, we exit a bit earlier. So we can simply just guess, right? What's the best duration? Should we increase the duration? Should we be further away from the price? Or should we be rather reactive and reduce the length and get closer to the price? What's the best duration here in order to trigger those buying and selling signals? When should we enter and when should we exit the market? And that's why we use these rather complicated tools to figure out what's the optimal duration. And this here is a summary of 200 backtests, of 200 simulations. So I simulated buying and selling, including trading fees. So you've got 0.2% in trading fees for each sale and for each buy. And even when including this, most backtests here outperformed buying and holding. So in black, we've got the HODL line. This is what you would have gotten if you just bought and held Bitcoin over the time, which was for the testing window 19% per annum. So we did have quite a few crypto winters here as well. And then on the x-axis, we've got the duration of the moving average. And on the y-axis, we've got the annualized return for each of those backtests. So over here, we see, for example, that trading according to the 20-day moving average would have given us pretty much the same performance as just buying and holding. If we take too short of a duration, then the trading fees kill us pretty much. If we lengthen the duration, we tend to outperform just buying and holding. So riding the waves does make sense. Once we reach 200 days in terms of moving average, we're getting very, very close to just buying and holding, because then we're not really reactive enough to the ups and downs of the market. So there is an optimum here, and the optimum is over here. And I haven't shared this duration before in the public channel, but now is the time. It is the 124-day simple moving average. And that's then what you want to be drawing in TradingView 124. This is the best moving average for Bitcoin. It's different for different kinds of assets, right? For Ethereum, it's a shorter duration. For a lot of altcoins, it's a shorter duration. Also, if you take aggregate measures, as in, for example, total 3, the altcoin market cap, it's also a different duration. But for Bitcoin, it tends to be relatively long in duration because there aren't too many active traders here. And the 124 days is the right one. This is what you should be setting your trading view to. And then if you want to get alerts even when these get crossed, you can click over here on alert and you can add whenever, say, the moving average crosses a certain value or the Bitcoin price, then send me an SMS or an email or a notification, whatever you want to get notified by. In order to activate this though, you need to have a paid version of TradingView. You can look at the different indicators, but for the alerts, you have to subscribe monthly. There is an affiliate link in the video description if you're interested in that. If you don't want to subscribe to this though, again, in the premium membership, there is an indicator alerts channel that tracks several best moving averages. So whenever a cross happens, it automatically gets flagged over here. And so what does this all mean? It means that in general, we should be following the trends. We should be rather betting on rising prices when we've seen bullish performance in the past and vice versa. When the bullish performance stops, when we simply just go sideways for too long or even we drift downwards, then we should start being cautious. So you don't want to necessarily be contrarian in Bitcoin, at least for this time period of 3 to 4 months or so. Of course, you can be contrarian if you have a multi-year horizon and we've seen a crash of 50, 60, 70%, then of course we can buy in. But if you want to ride those waves, 3 to 4 months seems to be the right general duration, and the 124-day simple moving average historically worked the best. That's what I personally use for BTC, and this is also what then directs a lot of my DeFi plays, as in what do I use, for example, as collateral in order to short altcoins that I'm bearish on. So you can, for example, for inflating altcoins, bet on falling prices and make money in that way. That's also explained in the many videos that we have in premium. So enough of the advertising. Let's all be happy that things tend to trend upwards. This is not common for the summer months in Bitcoin. Historically, Bitcoin did not perform too well during the summer, but right now things still look stable. Let's watch out though for this 26K level. If we do close a day below this whole situation turns around again, then we have to be cautious again. Right now, things do look positive. There's another video discussing how to ride those macro cycles. So if you have a longer time horizon, not just trading within 3 or 4 months, but if you simply just invest and allocate and dollar cost average in, then the next video is definitely for you. That comes over here. Looking forward to see you in that video. Bye-bye.